Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 12, Relative Valuation, Issue Number 49. Relative valuation is clear in a barter economy, one with no money, no medium of exchange. Perhaps 5 chickens are worth 1 pig, a bushel of apples, or a bolt of cloth. The value of a chicken or an apple is relative to one another and everything else. When using money, we sometimes neglect taking other products into consideration. The same applies when investing. The value of stocks is relative to the value of bonds and other products. Bonds versus stocks versus opportunity cost. While there are many various kinds of investments, bonds, stocks, commodities, annuities, real estate, and so on, in an effort to keep things simple, investors often recommend a split between bonds and stocks. One oft-touted rule of thumb is to invest 100 minus one's age in bonds and the balance in stocks, under the assumption that the older one gets, the more liquid they need to be, and therefore they require less volatility in their portfolio. This assumes bonds are less volatile than stocks, which they are usually, but not always. There are exceptions to nearly every rule. Graham advised that we always keep at least a 25 to 75% mix of stocks and bonds, or vice versa, depending on market conditions. In the 2014 environment of unprecedentedly low interest rates, I consider this to be one of those exceptions to the rule. You may decide to keep a sizable portion of assets outside of equities, in private real estate investment trusts, annuities, or some other investment vehicle. At current market conditions, I prefer a very heavy weighting of equities, especially if actively managed with conservative discipline. Most importantly, I feel an investor should be comfortable with their choices. If not, it could lead to panic during uncertain times, which is the worst time to be panicking. The basic concept behind relative valuation is that one's determination of the value of investment A may depend on the value of investment B. This should always hold true. My willingness to purchase Coke stock at $50 should always depend on my other alternatives. Suppose I feel fairly certain that at $50, Coca-Cola will return 10% annually over the next 10 years. If the 10-year yield on U.S. government bonds is 12%, that sounds like a better deal to me. Therefore, my willingness to purchase Coca-Cola will decline considerably. I may still be interested at $30, but not at $50. However, if the next best investment I can find only pays 5%, I may be willing to pay more than the $50 for Coca-Cola stock, even if it means to make less than 10% annually. That's just common sense. In my investment portfolio, I try to extend this common sense as far as possible. Suppose that I identify 4 companies and their growth prospects and their respective prices at which I believe they'll each return 10% annually on my investment. Suppose they all happen to be trading at some respectable discount to those prices, and I purchase them, 25% of each. As the price of one rises relative to another, given no change in expectations for their individual business prospects, the valuation of every company changes. Let's suppose that each of company A, B, C, and D would return 10% at prices of $10, $20, $30, and $40 respectively. If the price of company A rises such that it will now return 9% instead of 10%, my willingness to sell some of it and purchase the other companies increases, even if it pushes their returns under 10%, so long as they remain over 9%, I'm better off. As with any form of analysis, one can carry this all too far. I'm not recommending that anyone micromanage their portfolio, trading every time any stock price moves. That would be silly. I'm recommending that whenever you evaluate a particular investment, that you also take into consideration your other alternatives. Don't make the decision in isolation. This may also represent a minimum acceptable rate of return. It would seem imprudent to insist upon investing money in either bonds or equities without having an awareness of our minimum standards. There undoubtedly will be times when not investing at all is the right decision. I employ a simple system for opportunity cost. If I don't think an investment can generate a certain minimum return, say 6 to 8%, I sell it. Even if nothing better is available today, it likely will be before long.